Let's dive straight into a puzzle. Why is it that incredibly well-managed companies, the ones celebrated for their leadership, their innovation,
Hmm.
even their relentless focus on the customer and investing in new tech, why do they sometimes just, lose their way and fall from the top? Feels like a contradiction.
It absolutely does. And the sources we're exploring today, particularly the groundbreaking work found in the Innovator's Dilemma, argue that this isn't about companies becoming lazy or, bureaucratic or arrogant.
So not the usual suspects.
Exactly. It's about something far more insidious, actually.
You mean it's not the standard story of corporate decay we often hear?
Precisely. I mean, look at companies like Sears or Digital Equipment Corporation, DEC, or Xerox.
Big names, household names, some of them.
Right. And in their prime, they were paragons of good management. Sears, they revolutionized supply chains, store brands, credit cards.
Pioneers.
Totally. Yet they missed discount retail home centers. DEC was a titan in mini computers lauded, right around 1986.
And then missed the PC revolution.
Yeah. Completely. Xerox owned the big copier market, but missed the small tabletop ones.
And you mentioned integrated steel companies missing minimills, too. The list goes on.
It does. And what's fascinating here, what the sources really dig into, is that this failure often seems to stem from good management principles,
Yeah.
just applied in the wrong context.
Okay, hold on. Good management leads to failure.
Yeah.
That sounds wrong.
That's the core argument. It really turns conventional wisdom on its head.
Right.
What if always listening to your most profitable customers or investing primarily in your highest margin products, focusing on your largest markets, all hallmarks of seemingly excellent management? What if those are actually the decisions that make you vulnerable sometimes?
Wow. Okay, so that's the puzzle we're unpacking.
That's it.
And this is where it gets really interesting. The mission for this deep dive is to unpack exactly this paradox, drawing the most important insights from this material, and we'll use the fascinating, really fast-paced history of the disk drive industry as a key example.
It's a great case study.
Yeah. So this is your shortcut, really, to understanding this critical challenge, a challenge that faces you as you navigate a changing world, whether you're leading a team, building something new, or just trying to make sense of the business headlines. It's surprisingly counterintuitive stuff.
So to really get our heads around this, the sources introduce a crucial distinction: sustaining technologies versus disruptive technologies.
Okay, let's break that down. Sustaining first. What are they?
Right. So sustaining technologies are basically innovations that improve the performance of established products.
Making them better.
Yeah, better along the dimensions that mainstream customers already value. Think about how your phone gets like a better camera or a faster processor each year. It makes the existing product better at what it already does.
So in the disk drive world, that would be like making a hard drive bigger in capacity or faster, maybe more reliable.
Exactly. In the disk drive industry, these included some pretty radical changes in how data was read and written. Things like thin film heads replacing older ferrite technology, or magnetoresistive heads after that.
Complex stuff.
Oh, definitely. Complex, expensive innovations. But they allowed the industry to keep increasing storage density, cramming more data into the same space year after year. The basic Winchester architecture itself was also a sustaining improvement early on.
And the sources found that the established leading disk drive firms, they were actually excellent at these sustaining innovations, right? They weren't slow or behind the curve here.
Not at all, consistently. The data was really clear on this. In every single instance of a sustaining technology change that the researchers looked at, from minor tweaks to major, difficult overhauls, the established leaders were the ones driving it. They led the development, they led the adoption.
So they weren't risk-averse or technically incapable when it came to making their main products better for their main customers?
Nope. Clearly not afraid of technical challenges or large investments in that context. They were doing exactly what good management principles would tell them to do.
Okay. But then you have the other category, disruptive technologies.
Yeah.
And these are different.
Fundamentally different. A disruptive technology, when it first emerges, actually results in worse performance on the metrics that the established market cares about.
Worse, really?
Yeah. Think back to the first digital cameras compared to film. The resolution was lower, they were slower, maybe the color wasn't as good initially.
Okay, I remember that. Or early personal computers versus mainframes.
Perfect example. Far less processing power, much less storage. They couldn't run the big corporate applications.
But they must have been better on something else. Otherwise, why would anyone buy them?
Absolutely. They bring a different value proposition, something that appeals to a different set of customers, often in new, maybe smaller, emerging markets. They might be simpler to use or smaller, cheaper, more convenient.
More rugged sometimes.
Could be, or more reliable in a different way. It's a different package of attributes.
Like those early PCs. Not powerful enough for big companies, but small and affordable enough for, say, individuals or small businesses who never had computing before.
Exactly. Or think about discount retailers like Kmart versus traditional department stores back in the day. Maybe not as much service, maybe not the same ambiance, but they were cheaper.
Right. Or small off-road motorcycles compared to big Harley-Davidsons.
Yeah. Not as powerful for the highway, but great fun in the dirt. Or transistors versus vacuum tubes. Less powerful initially, but smaller, cooler, used less energy.
Okay, I see the pattern. And the irony here, the sources found, is that it was these initially inferior-seeming disruptive technologies, not the technically difficult sustaining ones that the leaders had mastered.
Right.
It was the disruptive ones that consistently tripped up the established firms and led to their downfall.
That's the paradox at the heart of the problem. It's why good companies failed. And this is where the disk drive industry becomes such a powerful, like a laboratory for seeing this happen.
The sources call it the fruit fly of business. Why that specific analogy? Is it just about the small size?
It's more about the speed of reproduction, or in this case, the speed of evolution. Things happened so incredibly rapidly in disk drives over a relatively short period.
Like what kind of speed?
Well, recording density was growing something like 35% per year. Drive sizes were shrinking at a similar pace, maybe 35% smaller each year. And the cost per megabyte plummeting, dropping maybe 5% per quarter for 20 years. Incredible pace.
Wow. Constant, relentless change.
Exactly. And that hyperspeed evolution allowed researchers to observe multiple cycles of technological change, market emergence, and crucially, competitive failure play out relatively quickly. You could see the pattern repeat.
So it wasn't just a one-off event for one company. They saw the same dynamics again and again.
That's key. Initially, you might look at that speed and think the leaders just failed because the technology was changing too fast, like a technology mudslide washing over them.
That sounds plausible.
It does. But as we just said, the data showed they handled the speed of sustaining change just fine. They were leading those difficult, fast-paced changes.
So if it wasn't the speed itself, what was the real story in disk drives? What was causing the leaders to stumble?
It unfolded, according to the research, through a series of shifts in the dominant physical size of the drives. These were the disruptive architectural changes. It started way back with large 14-inch diameter disks, used primarily in mainframe computers.
Right, the big washing machine-sized things you used to see.
Very much. Then came 8-inch drives. Now, these were smaller, obviously, but initially they had lower capacity and, importantly, a higher cost per megabyte compared to the established 14-inch drives.
So for a mainframe customer who wanted the absolute most storage for the lowest cost per bit.
The 8-inch drive looked pretty unattractive. Why would they want less capacity at a higher unit cost?
But they found a foothold somewhere else.
Exactly. They found their first big market in the new mini computers. Companies like DEC. Mini computer makers valued the smaller physical size, and they didn't need the absolutely massive capacity of the 14-inch drives for their applications.
Okay, so a new market valued different attributes.
Precisely. And then the pattern repeated. 5.25-inch drives emerged. Even smaller, even lower capacity initially, and again, often a higher cost per megabyte by the old mainframe metrics.
And let me guess, those didn't appeal to the mini computer guys at first.
Not really, but they found their first major market in desktop personal computers, which were just starting to take off. Think the original IBM PC and compatibles.
Right, needed something small enough to fit on a desk.
Then came 3.5-inch drives. Again, smaller, less capacity initially, their first big application. Portable computers, early laptops.
Laptops needed small, lightweight, maybe more rugged drives.
Exactly. Then 2.5-inch drives for even smaller portables. And it's interesting, the sources note the 2.5-inch drive was actually a sustaining technology for the laptop makers who were already using 3.5-inch drives. They just wanted a smaller version of what they had. But that same 2.5-inch drive could be disruptive if it tried to enter, say, the desktop market initially.
So whether something is sustaining or disruptive depends on the market context, the value network it's entering.
Precisely. And then the sources even mention 1.8-inch drives, teeny tiny. And their first major application wasn't even in computing.
Where was it?
in portable heart monitoring devices, apparently. A completely different industry valued that extreme miniaturization.
Wow. So the technology finds a home wherever its specific advantages are valued most, even if it's outside the original industry.
Right. And here's the critical finding the sources highlight, the thing that really drives the point home. Almost every single time one of these smaller disruptive architectural shifts happened, the move from 14-inch to 8-inch, 8 to 5.25, 5.25 to 3.5, the firms that came to dominate that new, smaller market size were almost always new companies, entrants.
Not the established leaders from the previous larger generation of drives.
Very rarely. The established leaders, despite their technical prowess, consistently miss the boat on these disruptive shifts.
Okay, so that's the core puzzle. If the big established companies have the technical capability, and the sources say their engineers often did build prototypes of these smaller drives, sometimes quite early.
Yeah, often using bootlegged resources, working on it in the background.
Right. So if they could build them, why couldn't they capitalize on them? Why did they let these new entrants, these startups, come in and steal the new markets away?
This is where the concept of the value network becomes absolutely key. The sources argue, really persuasively, that a firm isn't just a standalone entity making decisions in a vacuum.
Okay.
It's embedded in a network defined by its customers, its competitors, its suppliers, and crucially, its own internal cost structure and the financial expectations that come with it.
And this network, it influences decisions.
Massively. It creates a powerful pull, almost like gravity, that shapes what opportunities look attractive, what looks feasible, what looks rational to pursue.
So the definition of value itself changes depending on the network you're operating in. What's considered good performance.
Exactly. What a mainframe customer values think, maximum capacity, blazing speed, absolute reliability, maybe 247 service contracts, is very, very different from what, say, an early laptop customer values.
Who wants small size, low weight, low power consumption, maybe ruggedness to survive being carried around?
Precisely. The sources showed data comparing these different ranks of attributes across market segments. They were fundamentally different value propositions.
And you mentioned cost structures and margins. Were those different too?
Oh, wildly different. The gross profit margins on the big high-performance mainframe drives could be, say, 60% or more, huge margins.
Yeah.
But the margins on the smaller, high-volume PC or portable drives, much, much lower, maybe 15, 20%, sometimes less.
Right. So an innovation that fits into that lower margin network, even if it's technically interesting.
It looks financially unattractive, maybe even like a step backward to a company that's used to operating in that high-margin mainframe network. Pursuing it looks like bad business, like willingly accepting lower profitability.
Okay, I see that. So a big company, accustomed to those juicy 60% margins, looks at a potential new market for small drives with maybe 20% margins and thinks, that's not worth our time, our resources, our best engineers.
That's a huge part of it. Why divert resources from our profitable core business to chase this small, low-margin opportunity? It doesn't seem logical from a resource allocation perspective.
And there's another piece to this too, right? About technology improving faster than customers need it to.
Yes, that's another critical insight. Technology often improves at a much faster rate than customers in any given market can actually absorb or utilize the performance gains. Think about your phone processor again. It gets faster every year, but do you really need that much extra speed for checking email or browsing the web? Probably not.
Yeah, my old phone feels fast enough most of the time. There's an overshoot.
Exactly. The technology performance trajectory overshoots the performance trajectory demanded by the established market.
And this overshoot creates a space, an opening.
It does. It creates a space where those initially lower performing disruptive technologies, which aren't good enough for the established market today, have time to improve. They improve along their own trajectory, often focused on different attributes within their own new value networks, serving those new customers.
And as they get better and better, maybe faster, maybe cheaper, maybe smaller,
their performance trajectory eventually intersects with and maybe even surpasses the performance level that the original established market actually needs or is willing to pay for.
And suddenly that disruptive tech, which started out looking inferior and low margin, is now good enough for the old market.
Exactly. And often it comes in with a significant cost advantage because it was developed and manufactured within that lower cost, lower margin value network.
And the established firms are caught flat-footed.
Precisely. And what's really fascinating, or maybe tragic, depending on your perspective, is how the sources detail the typical, almost predictable pattern of decisions inside the established firms that leads to this outcome. It wasn't usually because of stupidity or neglect.
It was rational decisions.
That's the key. Walk through the sequence identified in interviews with managers from those established disk drive companies. First, as we said, smart engineers within the company, often using bootleg time or resources, spot the new disruptive technology, say, the smaller drive format, and they build a prototype. The technical capability is often there, in-house.
Okay, so step one, the prototype exists. What happens next?
Step 2, marketing gets involved. They take this new prototype out to their most important customers.
Big ones. The ones who buy the most of the current products.
Exactly. The lead customers, the profitable ones, the ones firmly rooted in the existing value network. Say, Seagate engineers build a 3.5-inch prototype, and marketing shows it to IBM, their biggest customer for 5.25-inch desktop drives at the time.
And those customers, IBM in this case, evaluate this new thing based on their current needs and the performance trajectory they expect from the existing 5.25-inch products, right?
Exactly. They're thinking about the next generation of desktops. They want more capacity, maybe 40 or 60 megabytes, not the 20 megabytes this little 3.5-inch prototype offers. And besides, their computer cases are already designed for 5.25-inch drives.
So the feedback is lukewarm or negative. It's too small, doesn't have enough capacity, it doesn't fit our roadmap.
Precisely. Interesting technology, guys, but not what we need right now. Come back when it holds more data. That's the kind of feedback they get.
Okay, and based on that customer feedback, the marketing team goes back and forecasts low sales volumes.
Right. Low initial demand from their main market. And then finance looks at it, sees the lower projected volumes, probably sees the inherently lower profit margins compared to the established high-capacity drive.
And it looked like a poor investment.
Exactly. So, step 5. Senior management has to make decisions about allocating scarce resources. Where do we put our best engineers? Where do we invest our capital budget? They look at the forecasts. They see the sustaining projects improving the existing 5.25-inch drives, promising larger markets, higher profits, and demanded by their best customers.
And they compare that to this disruptive project, the 3.5-inch drive, which looks small, niche, low margin, and not even wanted by their main customers yet.
The choice seems obvious, doesn't it? From a rational, data-driven resource allocation perspective.
Yeah, you prioritize the sustaining stuff. You focus on making more money, doing what you know how to do for the customers who pay the bills. That sounds like good, responsible management on the surface.
It absolutely does. And the sources link this directly to a fundamental principle. Companies are dependent on customers and investors for resources. That dependency creates this powerful gravity, pulling them towards pursuing opportunities that are valued by those external stakeholders.
So they shelve the disruptive project or give it minimal funding.
Right. Seagate, for example, shelved its early 3.5-inch efforts to focus on winning big contracts for improved 5.25-inch drives. Meanwhile, these established firms often move further upmarket in their existing value network. They add more features, more performance, chasing the high end, sometimes overshooting the needs of even their original mainstream customer base.
Okay. And while the established company is rationally focusing on its core, what happens? Step 7. The new entrant firms, the startups, emerge. They don't have relationships with IBM or the other big existing customers to protect. They don't have a high-margin business and cost structure they need to defend.
They're starting fresh.
Exactly. So they pursue the disruptive technology aggressively. They often find or even help create those new value networks where the disruptive tech's unique attributes, its small size, its low power, are valued. Think of Connor Peripherals partnering closely with Compaq, a leader in the brand new laptop market, to really tailor the 3.5-inch drive for that specific application.
They find the right home for it. They find the market that fits the technology, rather than trying to force the technology into a market that doesn't want it yet.
And then, step 8, the disruptive technology starts improving rapidly.
But along its own trajectory, in its new value network, it gets better capacity, maybe better reliability, maybe lower cost, driven by the needs of the laptop market, for instance.
Following its own performance curve.
Right. And then step 9. Eventually, that improvement trajectory catches up. It intersects with and maybe surpasses the performance level that the old market, the desktop market in our example, actually needs.
And suddenly it's good enough for the desktops too, and probably cheaper.
You got it. Step 10. Invasion. The disruptive technology, now mature and cost-effective, invades the mainstream market from below.
And the established firm, Seagate in this case, which had dismissed or underinvested in the 3.5-inch drive years earlier based on those perfectly rational decisions.
Now finds itself years behind the curve. The entrants like Connor have optimized the design, the manufacturing, everything. The established firm struggles desperately, often unsuccessfully, to catch up. Their earlier fear of cannibalizing their profitable 5.25-inch business becomes a self-fulfilling prophecy because the disruption happens anyway, and now they're not prepared.
Wow, that's
Yeah.
quite a detailed picture of how it happens. And if we connect this back to the bigger picture, this isn't just about disk drives, is it? This framework seems much broader.
Oh, absolutely not just disk drives. This framework helps explain why established, well-run companies are often brilliant at leading sustaining innovation, making good products better, but are so consistently vulnerable to disruptive innovation, the kind that changes the basis of competition.
It's not just about how radical the technology is or how the company is structured.
No, it's more subtle. It's about the powerful, often invisible influence of the firm's value network, its customers, its profit formula shaping its perception of what's possible and what's rational.
The sources mentioned some other related principles that reinforce this, right? Like, small markets don't solve the growth needs of large companies.
Exactly. A multi-billion-dollar company needs to find huge new markets to maintain its growth rate. A small, emerging market for disruptive tech just doesn't move the needle initially, making it easy to ignore.
And you can't really analyze a market that doesn't exist yet.
Right. Standard market research and financial analysis tools work well for existing markets, but fail miserably when forecasting demand for something truly new, serving customers who may not even know they need it yet. This makes investing in disruptive tech look incredibly risky on paper.
And the idea that an organization's capabilities define its disabilities.
Yeah, that's a powerful one. The very processes and values that make a company good at serving its current customers, its efficiency, its focus on high margins, its responsiveness to existing needs can become rigidities, disabilities when it tries to enter a fundamentally different market with different rules and a different business model.
And finally, that technology supply can outstrip market demand, the overshoot idea again.
Exactly. All these principles work together. The sources argue they're almost like economic forces of nature, like gravity. You can't just fight them head on with willpower. Success against disruptive threats comes more from understanding these forces and harnessing them, maybe by setting up separate organizations or finding ways to align the disruptive opportunity with the company's needs.
And you really do see this pattern playing out everywhere once you start looking for it. You mentioned some earlier.
Yeah, digital photography completely disrupting the film industry, mobile phones fundamentally changing the landscape for traditional wireline telecom companies.
Online retail versus traditional brick-and-mortar stores, that's still playing out.
Definitely. Distance education is putting pressure on traditional universities. Even in medicine, you see things like portable ultrasound, getting good enough to challenge some uses of big, expensive MRI or CT scanners in certain contexts.
And the sources even brought up electric vehicles as a potential current example. Right now, maybe they don't look like a direct threat to the core high-engine truck and SUV business for established automakers.
Right. The performance on some metrics isn't there yet for everyone. The cost is high. The infrastructure isn't fully built out. It looks disruptive.
But the potential is there. Maybe starting in different niches, different value networks, urban commuting, delivery fleets, performance segments, for it to improve along its own trajectory and eventually challenge the mainstream.
It fits the pattern quite well as a potential disruption. It requires a different approach, maybe a different organizational structure than just incrementally improving gasoline engines.
So reflecting on all this,
Yeah.
what stands out to you, the listener? Why does this matter? I think understanding this framework is incredibly powerful. It gives you a lens to question conventional wisdom.
Absolutely.
It helps you potentially identify disruptive threats to your own business or industry before they become obvious, when maybe something can still be done.
Or, on the flip side, it helps you spot disruptive opportunities that others might be missing precisely because they're trapped by their existing value network's definition of what looks rational or profitable today. It gives you a different way to see the world.
So wrapping this up, what does this all mean? The core message seems to be that great companies often fail when faced with disruptive innovation, not because they suddenly become poorly managed or stop innovating.
No, often they're innovating aggressively, but on the wrong kind of innovation.
Right. They fail because they're rational, disciplined, customer-focused decision-making processes, which are honed and rewarded in their existing business.
The very things that made them successful.
Lead them to systematically underinvest in or ignore these initially awkward lower margin technologies that seem unappealing today but might actually reshape the entire market tomorrow.
And that's the real innovator's dilemma, isn't it? Doing what is right and logical and rational for the health and success of your current business can be the very reason you are vulnerable to disruption down the line. It forces a really difficult choice.
Which brings us to maybe the biggest question this leaves us with. If the pull of the existing value network, the customers, the profit models, is so powerful in shaping perception and resource allocation. How can managers, how can you reliably identify, champion, and nurture truly disruptive innovations, especially those that by their very definition don't fit the needs of your current best customers and probably don't make sense within your current business model? How do you escape the gravity well?
That's the million-dollar question, isn't it? And maybe the starting point for another deep dive. Thank you for sharing the source material for this exploration into the innovator's dilemma and its crucial insights into navigating change.
Thanks for listening. Visit our library and subscribe below for more book summaries. This has been a Sprint Reads production.